While the market are closed for Thanksgiving, I sent an urgent email to my private list this morning warning that the economic signals are flashing red. Most people think the market is safe because it's quiet. It's not. We are seeing a massive divergence. The famous fear and greed index is showing fear right now near all-time highs. That makes no sense. Is the indicator broken? My custom market dashboard points to yes. It shows that retail investors are actually in full FOMO mode, chasing this rally while big money is away. This setup has crushed the VIX, which is the fear indicator, making portfolio insurance actually really cheap compared to a week ago. I'm Nico Bony, and today I'm going to show you the trap forming in the SP 500, the one chart that proves the economy is breaking, and how you can grab cheap protection before institutions return on Monday. So let's look at the SP 500. I have a few scenarios to show you, but first I wanted to show you that this week was all about FOMO. Here's my indicator. Last week was about panic. So as you can see, we went from a lot of panic to a lot of FOMO, and the FOMO was easy to be triggered this week because it was mostly retail investors since the big players were away for the week. So this is just something. So back to the SP 500. So as you can see, I talked about the topping process. Last time it wasn't so clear what was going on, but this time seems to be clearer because we seem to be doing a head and shoulder pattern, which is very bearish. And so I think that heading into the FOMC, we will likely have the potentially the top of that right shoulder. I'm not sure exactly where it will be, but likely around the FOMC, potentially on the day of the FOMC. And then I think we will have the big correction. I still have one bullish scenario. I have a bullish, bearish, and base case, but all of them point to having a low sometime in January. The Fed will likely react with emergency cuts. The government will likely react with some kind of announcement to try to restart the stock market. There will likely be a bounce into April, and then it will continue to go down. Uh, Either way, the most important thing is not the exact scenario of what will happen. It's just that because of the recent rally here with retail, there's an interesting thing that has happened is that the VIX has really gone down massively. So as you can see, 40% in the past few days. That's massive and means that insurance is cheap again. So if you have gains from this year, you can lock them in right now for pennies on the dollars. And I'll place the how to place a trade demo in the description below if you don't know how to execute this type of trade. So here I'm going on SPY instead of XPX just because it's easier to show you. So basically we are here right now. And so if you want to lock in the gain, here are just a few examples of what you could do. So first you could potentially replace the let's say you have 100 shares of SPY, you could replace them with one call for $28 per share. So that's only 4% of the value. And so you don't need a stop loss or anything else. If the stock market crashes, the worst you can lose it is 28 times 100 for 100 shares. So that's not bad. If you wanted to keep the shares, it's also possible to buy a downside protection. So for example, you could buy a put option, and that's like for almost 4 months, at a strike of 650. So that's a little bit below the latest low here and here. And it will only be for about 2% of the value of your share. So it's not bad in a way to be able to, put a cap on your losses. So if the stock market completely crashes, even revisit the lows of April, the worst would be is selling at 650 when people might be selling at 400 or something like that. It's even cheaper if you go lower. So if you go to 610, which is the highs of last year, which I mentioned could be a potential point for a bounce, it would only be 1% and it will still be for the same duration. So as you can see, potentially you can get protection up to March 20th for only 1 or 2% of the portfolio. So that's amazing value. And if you wanted, because the upside is likely limited, you could offset some of the cost of this insurance by selling a call. So you could be selling a call slightly above the all-time high, and you could sell it for $14. So if you sell it for $14, you would completely finance the protection here. So that's called the collar, and that's a strategy I teach. But basically, it's something that you could potentially do if you want it. Also, the 725 strike, which is even higher and is unlikely to be reached in the near term, would bring you $7, which could give you the money needed to buy the strike at 610. So there are many options, either just buying cheap insurance or financing the cheap insurance by selling a call or replacing it with an at the money call. There are just many options to minimize the risk. And right now, insurance is cheap. And when it was cheap like this in the past, it was, very good opportunities. Like, for example, I bought those kind of insurance around here because it was really cheap. I bought it again, before other big crash. So usually when insurance is cheap is because everybody is on the same side of the boat. So just something I wanted to share. This confirms it. Liner, one of the biggest home builder in the US, is running a Black Friday sale. They're offering up to $75,000 price cuts on homes that are only going for 200 or 300K. And get this, they are doing the $1 down payment that we saw the last time in 2006 or 2007, just before the global financial crisis. So this isn't a housing slowdown, it's a housing bust. This kind of data is why the Fed Reserve has pivoted. A few weeks ago, they were hawkish. Now, a December rate cut is seen as almost guaranteed. They aren't cutting because they want. They are cutting because they are driving in the fog, and the few signs they see, like the copper to gold ratio, are terrifying. We're likely moving from the normalization they've been talking about to actually emergency cuts by the end of January. So with the Fed cornered and the economy cracking, of course, money is moving to safety, like for gold and silver. This is the chart of gold. As I mentioned in the past, I was expecting this type of prosection, coiling, and then it's actually starting to break out. So we'll see if this will be confirmed. The best case scenario would actually be something like this. It goes up a bit, then it goes back down on the trend line, bounces, and then takes off again, because then you have a really good probability that the move is real and it's not a fake out. So that's something I'll be watching. For silver, we have something similar. So it's been calling into that shape. And right now it's hitting the resistance, which is the resistance from like a long time ago. This is the resistance from the 2011 top. So that's why, it's a very important resistance to break. And also you have the previous all-time high in here in white. But I'm expecting a similar perception for silver. It might not take off with this move because usually silver is a bit late after gold. But something like this is potential, and then there would be a breakout, some bounce on the trend line, and a confirmation of the move. So something I'll be watching. But yeah, gold and silver, they seem to be on track to continue their bull market. I think we're not done with both of them. For Bitcoin, I'll just show you quickly where I'm seeing things. So basically, right now, as I mentioned here, I was expecting a bounce. So the bounce already started. Of course, right now it's slowing down a bit at the trend line here, which was to be expected. But I think it will go within that zone. So between the Fibonacci 38.2 or 61.8 here, and it's likely to touch the 50%. So we'll see. They also put the bullish scenario in green, the bearish scenario in red. But I think the most likely is for the bounce to go in that zone. And then, because I think the stock market will tank, I think Bitcoin will likely go back down, potentially near the same level as this low, potentially a bit lower. I put here, 78. It might touch briefly. It doesn't have to, but I think this is the most likely scenario before resuming a move towards up, because I think, and this is still something fresh and new, so I'm not 100% sure, but I think this might actually be the shortest bear market Bitcoin ever had. That started on October 6th and might be about to complete in a few weeks or maybe in a few months, because I think people front running the end of the bull market, and so with so many people getting off the the Bitcoin train here, I think everybody who wanted to sell has sold, and so that's why I think we're close to a potential bottom, and then might the bull market might start early and catch everybody by surprise. So we'll see how it goes, but this is just how I'm seeing Bitcoin right now. There is one more massive piece of the puzzle, the AI bubble. There was a lot of information last week, including NVIDIA releasing a defensive memo to Wall Street and the US government just announcing the Project Genesis. But there's just too much to cover today, so I will be releasing a dedicated video early next week. Make sure you are subscribed if you don't want to miss it. Here's your action plan for Friday, November 20th. Check your portfolio risk. Realize that big players are coming back on Monday, likely to sell. And if you want to buy portfolio protection, use this low VIX to buy while it's cheap. I hope this helped. Let me know in the comments if you have any questions, and I'll see you in the next one.